This is the Insight is Capital podcast.
Tom O'Gorman is Senior Vice President, Director, and Portfolio Manager of Fixed Income at Franklin Bissett Investment Management. The views expressed in this podcast are those of Tom O'Gorman and Franklin Bissett Investment Management.
So now your outlook for U.S. economic growth, you're expecting it to continue along. I mean, the monetary policy continues to be largely accommodative.
Yeah, I mean markets are accommodative, but let's realize we are getting to a point where it's less accommodative. I have a couple things to say here, but one is you have to acknowledge, I think it's hard not to acknowledge that what central banks did, mainly the Fed, the ECB, and the Bank of Japan, was very stimulative to financial markets. And now that that's being taken away, you have to sort of ask yourself, what's that going to do to markets, and what's that going to do to the economy? Now, the Fed has two mandates: full employment and price stability as well. But even there, I mean, inflation in the U.S. was higher 3 or 4 years ago when they were doing QE than it is today. So, is it goods inflation the Fed's worried about, or is it financial market prices and inflation and the possible effects volatility could have on financial stability, and their desire just to get off of zero to have some dry powder to fight the next contraction? This is a really long cycle. So, that's one factor. GDP for the third quarter came out today for the U.S., and it came in below expectations. People thought for the third quarter in a row you'd get 3% real GDP, and it came in, I believe, at 2.6, but it was still a good number, and so it's a couple quarters in a row. But I think what you have to look at is in the U.S. how a lot of it's being led by consumer expenditure, so consumption, and is that being driven by wage growth and jobs, or is it being driven by taking down the savings rate and or borrowing money? And honestly, everything we look at tells us it's not wages, that it is. There was massive amount of growth in credit, consumer credit over the 2017 period, and especially towards the end, and the savings rate is being drawn down to near record low levels. So, is that sustainable? I guess our view is we think the U.S. can do better, and it gets this one-time pop from the tax changes, and it's certainly getting some I guess you're having some impact from taking away regulations and the Trump administration doing things like that. But the question is it really sustainable over the long term? And, for that, we're still a little bit suspect. But, as long as the market's giving the Fed a green light to raise rates, we do think they will continue to do so, moving forward. So we'll see, and I would expect they will move more aggressively than the Bank of Canada.
It sounds as though your expectations, at least your view of monetary policy right now remains fairly precarious in the sense that they need to be careful about the rate at which they increase interest rates.
Yeah, I'd say so. One, because of how unconventional the policies, at least by the three large central banks, how unconventional their policies were, and for how long, they did quantitative easing, and the trillions of dollars they put on their balance sheets is never done before. We've never had an unwinding of this type of stimulus, and you have financial markets, and it doesn't matter. Pick a market, and you can almost come up with a valuation that's at a record high, or a credit spread measurement or metric that's at a record tight, or at least near tight. So nothing is cheap, so there's less room for error. And, I mean, let's face it, most contractions and recessions and financial accidents and things that have happened have come from central banks being too aggressive. I mean, the Fed's rate increases from 04 to 06, the 300 basis points of rate increases with a lagged effect brought us to the, what we saw 2007 and 8. And you can easily come up with a scenario in Canada that if the Bank of Canada was too aggressive, and sort of undoes the mortgage market at the same time having, the Canadian dollar go up 5 or 10 cents from here. I mean, that's a pretty easy scenario for me to say that that's an uh-oh moment. So, we're bond guys. We're bond managers. We're naturally a little bit sort of cautious because, when I lend just company XYZ in Canada money, the best I'm going to get back, I'm going to get my money back and I'm going to earn the yield on that bond. I don't have a ever-expanding PE ratio to drive up the value of my bonds. So we're always cautious around what central banks are going to do. I actually think, though, having said everything I said, this is as good as it gets. I mean, you have thus far, central banks have been able to start reversing the overly or the generous stimulus they've put in place for years. You have synchronized global growth. You have all these asset markets at record type levels. You have these tax cuts filtering through. So they're like for financial markets, this is a pretty attractive time. The problem is, valuations matter. It's not just the fundamentals. It's
correct.
What are you getting paid to take the risk? So that's something that investors are going to have to grapple with as we go forward from here. And it's not to say there aren't a plethora of uncertainties out there either. I won't even go into them, but I mean, you can turn the news on in any day on any channel, and whether it's geopolitical or otherwise, there's a lot of stuff going on that people seem to sort of, at least in financial markets versus I think that how the reaction would have been 15 or 20 years ago, it seems to sort of get ignored. And certainly the tax changes with regards to the U.S. equity market still seem to be filtering through, and we're having quite a run with regards to U.S. equity markets.
So given the going back just to something that you said earlier, the uh-oh moment, where at the same time, if the uh-oh moment comes, is there a chance the Bank of Canada would retrace on their tightening, or that they would?
Absolutely. It's possible. I was out traveling with, meeting with a lot of financial advisors this week out in Quebec, and I got that question, and I thought that was really insightful that amidst all of this, that somebody was sort of asking the question, all you're talking about is, or what the markets are talking about, and pundits is rising rates. What's the possibility that the next move or one of the next moves is a cut? And I mean, that remains to be seen. I'm not gonna call that and say that's our base call, but it's certainly possible. We don't know what these new B20 rules are going to do. You don't know what's coming out of NAFTA. And, and some of this can be posturing or negotiations, but, the fact that the Trump administration just put new tariffs on solar panels and washing machines, and, talked about this whole, even today in Davos, this whole America first and America being open for business. We'll see. But global trade is something, if it's not handled properly, those moves can have meaningful effects, and how countries respond. I mean, what's Canada's one thing it can do to ensure competitiveness? And that's certainly having the right level on the currency. A weak currency that weakens too much isn't very good either, because it just kills your purchasing power. The country at some point becomes poorer, but within a certain range, you could see the one thing that Canada could do is try to target the currency to a level that sort of at least makes it competitive during an uncertain time while we're going through the ramifications if NAFTA is torn up or something like that.